Welcome to our examination of monetary policy, the Federal Reserve System, and regulatory policy. The federal government seeks to influence the value of money by controlling its availability. When more money is in circulation, it is lower in value. Consequently, consumers need to spend more money to keep buying the same goods and services. Inflation is at work. The costs of running a business also increase with inflation. As a result of increased costs and decreased sales, because fewer people can maintain their level of spending, businesses may choose to lay off workers. To avert these potential problems, the Federal Reserve, the nation's central banking system, works to maximize employment, ensure stable prices by keeping inflation low, and moderate long-term interest rates. Congress and President Woodrow Wilson established the Federal Reserve System in 1913. The Fed is composed of the Board of Governors, a government agency whose members the President nominates and the Senate must confirm, 12 Federal Reserve banks, and the Federal Open Market Committee. The Board of Governors, the President of the Federal Reserve Bank of New York, and the presidents of 4 other Federal Reserve banks who serve on a rotating basis make up the FOMC. Today's current chairwoman of the Federal Reserve is Janet Yellen. She was just recently confirmed by the Senate. Today, the Fed's responsibilities include setting monetary policy, the body of government policies aimed at maintaining price stability. 2, supervising and regulating banking institutions. 3, maintain the stability of financial markets. And 4, providing financial services to depository institutions, the national government, and foreign official institutions, central banks of other nations and international organizations such as the International Monetary Fund, or IMF. The Fed has 3 primary tools for setting monetary policy. It can raise or lower the reserve requirement, the amount of money that financial institutions must keep out of circulation. In times of high inflation, the Fed may raise the reserve requirement to decrease the amount of money available through credit, hence decreasing the money supply. The Fed can also raise or lower the discount rate, the interest charged to financial institutions that borrow money from the Federal Reserve Bank, and thereby make it more or less costly to borrow money. The Fed action that most influences the money supply, however, is its decision to buy or sell Treasury securities, bills, notes, and bonds, which represent loans of money to the government to meet expenditures not covered by tax revenues. The Fed sells Treasury securities when it wants to decrease the money supply and buys them to increase the supply. Beyond its authority to set monetary policy, the Fed exerts supervisory and some regulatory authority over some 3,000 banks that are members of the Federal Reserve System, including all commercial banks chartered by the national government and those state charter banks that choose to join the Federal Reserve System, companies that control banks, and the U.S. activities of foreign banks. However, the Fed is not the only federal agency supervising and regulating the banking and financial industries. For example, the Office of the Comptroller of the Currency, OCC, created in 1863 as a bureau within the Treasury Department, also charters, supervises, and regulates national banks. The Federal Deposit Insurance Corporation, or FDIC, an independent agency established in 1933, supervises state-chartered banks that are not members of the Federal Reserve System. Since the mid-1800s, the national government has created numerous regulatory agencies charged with ensuring the safety and soundness of the nation's banking and financial industries and systems, with the ultimate goal of promoting a healthy national economy. Please be aware that this is regulatory policy, not necessarily associated with the Fed. As stated by Adam Smith in 1776, in theory, the competition that characterizes a free, unregulated market serves the public good by producing the range of high-quality and affordable products and services that citizens need or demand. Free market advocates assume that competition provides for the public good. Yet, at times, the competition of a free, unregulated market may harm consumers, workers, and the environment. Indeed, competition among private entities, each trying to make a profit, may threaten public safety and health. Consider, for example, the unsafe products, including dangerous food and drugs, that may be manufactured and sold to make a profit. Think about production and manufacturing processes that may pollute the air, water, and land, creating conditions that are injurious to public health. Competition may also lead firms to cut salaries and benefits to ensure their profits, or their very survival. Such cuts decrease workers' ability to earn wages and benefits that keep them in the middle class, or even out of poverty. Unsafe and unhealthful working conditions may be another cost that workers pay so that firms can hold down or reduce production expenses. Moreover, if marketplace competition results in fewer firms driving out their competition, they then have the power to raise prices or produce goods of lower quality, harming consumers. Recently, the United States experienced a failure in the financial market to channel funds from savers to borrowers because of risky decisions by numerous financial and banking institutions. Loans and credit lines extended to people without the means to repay the borrowed money sparked an increase in the number of people who could not pay their mortgages and therefore lost their homes. Hundreds of billions of dollars worth of mortgage-related investments went bad by the fall of 2008, and several large, prominent financial and banking companies collapsed. President Bush and Congress began discussions about the need for new regulations for the banking and financial industries to prevent similar market failures in the future. That's where you heard the term too big to fail. Congress and President Obama's administration continued those discussions, focusing on protecting consumers of the banking and financial industries. In the summer of 2010, President Obama signed legislation establishing the Bureau of Consumer Financial Protection, an independent unit within the Fed. The Bureau of Consumer Financial Protection has the authority to regulate a wide range of financial products, including mortgages and credit cards, and to collect and monitor consumer complaints about the financial and banking industries, and a responsibility to educate consumers about financial products and services. In the U.S. economy today, the government regulates marketplace practices to protect the public. This regulation occurs in two broad categories: business regulation and social regulation. Business regulation includes government policies that aim to preserve competition in the marketplace. Social regulation refers to government policies directed at protecting workers, consumers, and the environment from the harm caused by marketplace competition. Earlier this year, we surveyed the administrative rulemaking process by which executive branch agencies establish businesses and social regulations. In this discussion, we traced the evolution of these two types of regulatory policy. The federal government created the first agency for the purpose of regulating business, the Interstate Commerce Commission, in 1887. The ICC, or Interstate Commerce Commission, initially regulated the prices of the services provided by the railroad industry to protect the livelihood of farmers who relied on the nation's rail lines to transport their goods to distant markets. Next, in 1914, the federal government established regulations to prevent large corporations from engaging in business practices that harmed marketplace competition and established the Federal Trade Commission, or FTC, to oversee these regulations. In 1934, during the Great Depression, the government created the Securities and Exchange Commission, SEC, to regulate and make transparent the nation's stock markets and financial markets. Another regulation of the Depression era, the National Labor Relations Act of 1935, commonly known as the Wagner Act, authorized the national government to regulate interactions between management and labor unions. The Wagner Act empowered union members by guaranteeing the right of workers to unionize and elect representatives to bargain collectively with management for improved work wages and working conditions. Moreover, the Wagner Act outlawed certain management practices that Congress considered unfair to labor, and hence a potential threat to the economy. Then, in 1947, Congress overrode President Harry Truman's veto and passed the Labor Management Relations Act, or Taft-Hartley Act, which identified and outlawed labor practices Congress deemed unfair and restricted the right to unionize to non-supervisory employees only. Thus, within 50 years of the creation of the first regulatory agency, the ICC, the national government had put in place a full range of business regulations, from regulating prices and standards in industries, to criminalizing business practices that restrict marketplace competition, to making stock transactions transparent, to regulating labor management relations. Today, the government regulates the marketplace in a wide variety of ways in the interest of creating and maintaining a healthy economy. The national government also uses social regulatory policy, which aims to protect the public's health and safety, to safeguard workers, consumers, and the environment from the potential harm created by the competitive quest for profits in the marketplace. Like business regulation, social regulation has an economic impact because it increases the costs of doing business. Scholars see precedents for social regulation in two 1906 laws that protected public health: the Pure Food and Drug Act and the Meat Inspection Act. Upton Sinclair's descriptions of the dangerous and unsanitary conditions in the Chicago meatpacking industry in his novel The Jungle motivated President Teddy Roosevelt to sign these two laws. The Pure Food and Drug Act created the Food and Drug Administration and charged it with testing all foods and drugs produced for human consumption. It also requires individuals to present prescriptions from licensed physicians to purchase certain drugs and mandates the use of warning labels on habit-forming drugs. The Meat Inspection Act requires government inspection of animals that are slaughtered and processed for human consumption and establishes standards of cleanliness for slaughterhouses and meat processing plants. The federal government first addressed working conditions that jeopardize workers' health when it enacted the Fair Labor Standards Act in 1938. The FLSA established standards for legal work week, overtime pay for those working more than the standard work week, minimum wages, record keeping for workers' hours, and limits on child labor. President FDR characterized the law as the most far-reaching, far-sighted program to the benefit of workers ever adopted. In the 1960s, the government focused anew on growing concerns about product quality and safety. In his 1965 book, Unsafe at Any Speed, attorney and consumer advocate Ralph Nader warned that a great problem of contemporary life is how to control the power of economic interests, which ignore the harmful effects of their applied science and technology. Although Nader's books targeted the unsafe cars rolling off the assembly lines of the U.S. auto industry, his warning was equally relevant to the countless American industries that were discharging chemicals and toxins into the environment. Nader's book ignited a consumer safety movement, and a related environmental movement was born with the first Earth Day in 1970. Lobbying by concerned citizens and interest groups led to the passage of the Environmental Protection Act of 1970 and the Consumer Product Safety Act of 1973. These far-reaching federal laws aimed to regulate business practices that threatened consumers' health and safety as well as the environment. The Federal Consumer Product Safety Commission, created through the CPSA, or Consumer Product Safety Act, is charged by law with protecting the public from unreasonable risk of injury associated with more than 15,000 consumer products, including toys, products for children, products for inside and outside the home, and products made for sports and recreation. The CPSA can recall such products if it deems them unsafe, just as the FDA can recall food and prescription medicines it judges to be unsafe. The CPSC and the FDA post recall information on their websites. The financial and economic freefall that began in 2007 sparked a national conversation about the need for additional regulation of the financial and banking industries. In 2009, President Obama and Treasury Secretary Timothy Geithner proposed restructuring the numerous existing federal agencies that regulate the financial banking industries. In addition, they proposed the creation of a new agency to oversee financial products sold to consumers to protect consumers and the economy. In 2010, Congress and President Obama created the Bureau of Consumer Financial Protection. Market regulation has unquestionably lowered the risk of harm to citizens and the environment caused by marketplace competition. It also has cushioned economic downfalls. But the burden of government regulations has driven up the cost of doing business, and in the end, consumers pay for this cost. In many industries, this increased cost poses greater problems for smaller firms than for larger ones. The higher costs caused by regulation may also put U.S. industries and firms at a competitive disadvantage in the global marketplace, because many other countries do not impose regulations. Therefore, the production costs of firms in other countries are often lower than those in the United States. The lack of regulations imposed by governments in other nations is a growing concern in the United States. The FDA and the CPSC are recalling numerous products manufactured in foreign countries, and even some products manufactured in the United States that use ingredients or components from foreign sources, one major one being lead. Because of these concerns, trade policy and the interdependence of the global economy are prominent contemporary issues.